Welcome to the second episode of Finance the Fog. I'm Jeff Morneau, and today we're going to be talking about the widow's penalty. So, the widow's penalty is an umbrella term that covers a spectrum of consequences that can arise when, in the eyes of Medicare or the IRS or the Social Security Administration, you're viewed as single as opposed to married, particularly following the death of a spouse. So, it's not a penalty per se, as in you did something wrong and they're calling a foul on you, but it can have negative consequences. So I think the term does elicit an appropriate negative connotation to it. So there's a ton to talk about. We're going to talk taxes, Medicare, Social Security, among others. But before I do want to give a disclaimer that the information discussed here is solely for educational purposes, not to be construed as tax, legal, or investment advice. And all information is believed to be from reliable sources. However, I make no representation as to its completeness or accuracy. So without further ado, let's jump right in. The widow's penalty on the second episode of Finance Through the Fog.
Welcome to Finance Through the Fog, a podcast where we discuss the intersection of widowhood and financial planning and how you can prepare yourself to navigate financial transitions while experiencing the fog of grief and loss. Now, here's your host, certified financial planner, Jeff Morneau.
So today we're going to be talking the widow's penalty. And like I said, the widow's penalty, it traverses taxes, Social Security, and Medicare. But the first place I want to start talking about the widow's penalty is actually in the filing statuses of the individual tax return, also known as the 1040. So that's because in the filing status is where the catalyst for the widow's penalty really begins. So to review, there are 5 different statuses for an individual's tax return, and that is single, married filing jointly, married filing separately, head of household, and qualified surviving spouse. And so the widow's penalty really occurs when you switch from married filing jointly or married filing separately, but by and large, most married couples file as jointly, when you switch from that to filing as a single individual. And so you may be thinking, you just listed off the 5 filing statuses. There was something about a qualified surviving spouse. Why would I file as single if I could file as a qualified surviving spouse? And the answer is that may not be an option for you depending on your situation. So to file as a qualified surviving spouse, you must have a qualified child as a dependent. In the case of the qualifying surviving spouse filing status, that would be a child, stepchild, or adopted child under the age of 19 or 24 and still in school, and who the surviving spouse provides support. So if that's the case and you find yourself in that situation, then yes, you could file as qualifying surviving spouse for 2 years following the death of your spouse, as long as your dependent child still meets those requirements. And of course, you don't remarry. In the year of death, this is really important. In the year of death, you can always file as married, assuming that you were married when your spouse passed away. So that's really important, because when we talk about the widow's penalty, again, a lot of it is switching from married filing jointly to single. And so having that last year to file as married filing jointly, there could be some tax planning and financial planning involved in that. Okay, so that's kind of what we're talking about today. So let's look at a timeline of how this would actually work in practice. So let's just say you're a younger widow and you have a 12-year-old child who lives with you, and your spouse passed away in 2025. Okay, so in 2025, you could file as married filing jointly. And then because you had that dependent child, you could file as qualified surviving spouse in 2026 and 2027, after which you would then have to file as head of household, presumably for 4 more years or longer if your child is in school. But then when you no longer have that dependent, then it would be filing as a single filer. However, let's say your spouse passed away in 2025 and you're an older widow, so your kids are all grown or you don't have any kids. Well, then you would get 2025 to file as married filing jointly. But after that, next year, you would have to file as single. And so therein lies the widow's penalty. Okay, so what is the widow's penalty? Or put differently, why is it not advantageous to file as a single filer? So if we're talking taxes here, with filing single as opposed to married filing jointly, you get hit on 2 different fronts, okay? So on one front, your standard deduction is cut in half. So in 2025, that would go from $31,500 to $15,750. So literally cut in half. And that's assuming you're under 65 and not blind. You would get a small increase in that deduction if you were either of those qualifications. So what does this mean? That means that if you take the standard deduction instead of itemizing, so your itemized deductions don't aren't larger than your standard deduction, so you take the standard deduction. Well, right off the bat, 15,750 more of your income is going to be included as taxable income, filing single as opposed to married and filing jointly. Okay, so that's one front. On the other front, now the brackets are much narrower for single than married filing jointly. Okay, so for example, here, if we're talking the 22% bracket, for married filing jointly, you would hit the 22% bracket at just nearly $97,000 of taxable income, while it would be just over $48,000 of taxable income that you would hit the 22% bracket filing as single. Okay. Also, for older widows, we now have the extra deduction for seniors provided through the OBBBA, and that's 2025 through 2028. So, as you may or may not know, those 65 or older on New Year's Eve get up to an extra $6,000 of deduction per person. So if you and your spouse were both above 65 or 65 or older, that could be a total potential of $12,000 of extra deductions. Okay. So right off the bat, if your spouse passes away, you might think, okay, that's going to reduce me down to $6,000, which is true, but there is income phase outs for this extra deduction as well. And so the phase out starts much lower for a single filer than for a married filing jointly. Okay, so let's look at an example here of what I'm talking about, because I think it might make more sense with numbers. So if we have $140,000 of modified adjusted gross income and you're married filing jointly, both 65 or older, you would get the full $12,000 extra deduction. Okay. As a single filer, you would only get, you might think, okay, as a single filer, I would get $6,000 of that deduction. No, you would actually get $2,100 of that deduction. That's because A, you're down to $6,000 filing single, but now because you're imposed on the lower phase out for single than married filing jointly, you hit that phase out threshold and you're nearly 2/3 of the way through it. So that's why it's reduced to $2,100. Okay. So you throw in on top of that your standard deduction being cut in half. Well, you could go from a combined standard deduction of $47,500 to a combined deduction of $20,250. So that's a huge drop in standard deduction. And I think that is actually a good example of the compounding effects of the widow penalty and how a lot of these variables are interrelated and can affect each other. Okay. Now, going back to qualifying surviving spouse, everything there besides the name resembles married filing jointly. So for those 2 extra years, if you qualify, you could think that you get the deductions and the brackets of married filing jointly. So you do get a little bit more of an off ramp to filing a single as opposed to not having a qualifying child, adopted child, or stepchild. Okay. So now let's switch over and talk about Social Security. So it is true that if you and your spouse are both currently taking benefits, the surviving spouse gets the higher of the two benefits. And so you may say that doesn't really sound like much of a penalty if I get the higher of the two benefits. I would reiterate that is good that you get the higher of the two, but you don't get both. So there will be a reduction as far as a household is concerned. To me, this would have the greatest effect on two spouses if they each have their own benefit and they're fairly equal, because then you could imagine it would be a roughly 50% reduction in Social Security income to that household. On the other hand, should both spouses be pulling from the same benefit, so by that I mean one spouse is taking their own benefit and the other spouse is taking a spousal benefit off that benefit, then there would be closer to a third reduction in Social Security income for that household. If you haven't claimed Social Security and you are wondering about claiming strategies for planning for widowhood, I would go listen to my last episode where I do a deeper dive on Social Security survivor benefits as they pertain to retirement. I do also want to shed some light on a positive movement that's happened in the Social Security space recently as it pertains to widowhood, particularly for those widows who have paid into a pension system. So there's two Social Security provisions, WEP and the GPO, that affected how pensions interact with Social Security. The one that would have negatively affected widows would have been the GPO, government pension offset. And in short, what the provision said was, okay, if we look at two spouses that have paid in Social Security, if one spouse passes away, the other spouse gets either or. They either get their own benefit or they get the survivor benefit. They don't get both. And so the provision actually reduced survivor and spousal benefits based on if that other spouse had just paid into a pension system. And Congress recently rethought it and they said, nah, we're going to give them both. So now those widows who have paid into a pension system and their deceased spouse paid in Social Security can get an unreduced survivor benefit, which is a really nice thing for those widows who have paid into a pension system. Okay. Now let's look at the third place where we see the widow's penalty, and that is with Medicare surcharges. So let's start with a quick overview of Medicare. There are 4 parts to Medicare: A, B, C, and D. A is hospital insurance, and for the vast majority of those on Medicare, there is no additional cost for Part A. They've paid enough in Medicare payroll taxes through their working careers. Part B is doctors and outpatient insurance, and there is a base premium to that, and there can be adjustments to that, which we'll talk about. Part C is Medicare Advantage, which is sort of an aside because that's if you decide to go the private insurance route, you'd be on Medicare Advantage or Part C. That's a whole other separate conversation, although I will make a point about Part C as far as the widowhood penalty is concerned, which is that your mind might go to a place where you're like, okay, I'm going to be on Part C so I don't have to pay A or B or D IRMA surcharges, and it doesn't work like that. So you will have to pay IRMA surcharges even if you're on Part C if your income was high enough, okay? And then there's Part D, which is drug insurance, and similar to B, there is a premium, or there can be a premium to Part D, but it's not as costly as Part B. So when we're talking about the widowhood penalty here, with Medicare, we are typically referencing IRMA, or income-related monthly adjustments amounts. And like the name alludes, IRMA is an increase to those premiums that are stacked on top of the base premium, and they are triggered by having an elevated modified adjusted gross income. So there are 2 unique things about IRMA I want to talk about. The first is that it's a 2-year look back. So what that means is that the 2026 IRMA surcharges, they would be based on your modified adjusted gross income from your 2024 tax return, okay? The second unique aspect to IRMA, which could seem rather intuitive, but it is somewhat unique, is that it's a cliff. So if you go $1 over an IRMA bracket, your entire premiums are stepped up to that for that year, okay? So it's not like even in taxable income where if you go $1 over then a bracket, then that extra dollar is taxed at that bracket, not the total amount. Or like we saw with the extra senior deduction, there's income phase outs. No, this is just a cliff, which can drive people crazy if you trip over one of these IRMA brackets. Let's say you're doing Roth conversions and you trip over an IRMA bracket. So for that year, your IRMA surcharges are elevated. Okay. So let's see how this would play out as far as the widow's penalty is concerned. And let's actually look at real numbers here. So the 2026 IRMA brackets just came out. And if we look at a married couple, okay, and let's assume that married couple had a modified adjusted gross income of $210,000 from 2024. Again, 2-year look back. So that married couple, $210,000 in modified adjusted gross income, there would be no IRMA surcharges. They would just have the base premium, which for 2026 is going to be $202.90 per month per person, for a total of $4,869 per year for Part B of Medicare. Honestly, with the level of care you can get on Medicare, I don't think that's too outrageous, right? So that's not necessarily a bad deal. However, if we flip it over to someone who's filing single, so a widow who's forced to file single, that would put that widow into the 4th IRMA bracket, which would actually be, including the surcharges, $649.50 per month for Part B, and an additional $83.30 in Part D premiums, for a total of annual payments and premiums of $8,790 for that single filer. And so if you're like me, you're like, how is it possible that a single widow could pay nearly twice as much as a married couple combined in Part B and Part D premiums? But that's just the way IRMA works. And so you can imagine this could drive a lot of people crazy. And so you may ask, is there anything you can do to help alleviate this? There is a form that I would keep in mind, and it's SSA 44. And how the form works is that you can appeal an IRMA surcharge if you have what is considered a life-changing event. And you may ask, is death of a spouse a life-changing event in the eyes of Medicare? And the fact is that it is. So you can use SSA 44 to appeal IRMA surcharges, but it's important to remember that the form is actually for the 2-year look back. So it's basically saying in the last 2 years, since we took your modified adjusted gross income, has there been any change that it would be unfair for us to impose this IRMA surcharge on you? And so you can't use it forever. You can just use it in the year of the death of the spouse and then the following year. Okay. Now I want to touch on one aspect that typically isn't talked about with widowhood penalty, particularly because I don't think it really is affected by widowhood penalty per se, but I do want to touch on it because if you're experiencing widowhood, you might look at the tax code and say, am I going to be affected by this? So that's why I want to talk about it. And that is the exclusion for a primary resident of the sale of your home. So if you're not familiar, married couples get up to a $500,000 capital gain exclusion on the sale of their primary home, as long as they have lived there for the last 2 of the 5 years. There's an ownership test and a residency test. And that same test applies to a single filer, but they only get $250,000 of exclusion for the sale of the home. And the reason I bring this up is because I think a lot of people who go through widowhood might want to move for a variety of reasons. Perhaps their home is just too many memories there, or it's too much home for them to keep up, or they were waiting maybe for their spouse to pass away, then to move closer to family somewhere else. Whatever the reason, there's a variety of reasons why they might want to move. And if they live in a highly appreciated home, they may wonder, am I going to get dinged by this by losing the $500,000 of exclusion? So I do want to mention that you do have a 2-year grace period to still use the $500,000 exclusion as long as you've met those residency and ownership tests. Okay. So that is nice that they offer some grace to widows and who are looking to sell their home. There also, which is really beyond the scope of this episode, because it's just a whole other episode in itself, but there is a step up in basis or a half step up in basis of assets jointly owned by your spouse. So if you live in a home and it's jointly owned by your spouse, depending on if you're a community property state or not, but either way, you should get hopefully a step up in basis, which could also help with the sale of your home, because then there'll be less of a capital gain if there is a step up in basis at death. So just something I want to mention, because I think it's important for people. I think it's important for people to know that they have a way to sell their home after the death of a spouse, if that is something that they want to do. Okay, and so let's look at some numbers real quick, just to get an idea of how this would actually play out with some real numbers, but in a hypothetical situation. And so let's start with a married filing jointly couple here. Let's assume they have $8,000 in taxable interest, $70,000 in a taxable IRA distribution, and $72,000 in Social Security income in 2026. So these are 2026 numbers, okay? And let's compare that to what it would be if you were filing as a single filer. So here, still $8,000 in taxable interest, $70,000 in that IRA distribution, but for the single filer, I'm including $48,000 of Social Security as opposed to $72,000, because that $24,000 reduction in Social Security is, I'm presuming, the spousal benefit. So you had a third reduction in Social Security after the death of a spouse here. I'm also assuming everyone in this scenario is over age 65. So let's start with the standard deduction. For the married filing jointly couple, it would be $35,500. For single, $18,150. So that's a reduction of $17,350 for filing single as opposed to married filing jointly. Okay. On top of that, we have the extra senior deduction, the OBBBA one. That is $12,000 for married filing jointly. That is down to $3,372 for the single filer, because again, they lose that spouse. That spouse is $6,000, but also now they're in that phase out of modified adjusted gross income. Okay. So if we go down to look at how that would affect the total tax because of the condensed tax brackets, we see the married filing jointly couple that has $24,000 more of Social Security paying $10,508 in federal income tax. The single filer with $24,000 less of Social Security is paying $16,113. So the single filer would be paying $5,605 more in federal tax than the married couple with $24,000 less Social Security. And we're not even talking about IRMA brackets here. So you can really see the widowhood penalty at play when you get into the weeds with how this would be affected filing status wise with income. Okay. And so now let's talk about how you can help mitigate or reduce the widow's penalty. We spent a lot of time talking about what it is. So let's talk a little bit about some strategies here. So from a tax and IRMA perspective, the low hanging fruit strategy would be Roth conversions. So a quick overview of how Roth conversions work is they pertain to pre-tax contributions to tax advantage accounts. So we're talking, I like to think of the fours: 401k, 403b, 457, 401a, or your IRA. So money that's been put into them on a pre-tax basis by you or your employer, and then they've grown tax deferred. So that means that just like Vegas, whatever happens in those accounts stays in those accounts as far as dividends, interest, capital gains is concerned. And so you have you could accrue a good amount of pre-tax money that is taxed as ordinary income on the way out. Okay. And so a Roth conversion is when you strategically go in there and you say to the IRS, I want to start paying some taxes now on some of these funds, but instead of taking them as a distribution, I'm going to convert them into a Roth account. And then assuming you take them out in a qualified way, that will be tax-free growth and tax-free income after you've paid taxes on them. So where does this come in with the widowhood penalty? So the idea is that either in the year of death, you can still file married filing jointly. If you're qualified and surviving spouse, you get 2 more years on married filing jointly brackets and deductions. You may be in a situation where you find out that your spouse is a year or 2 years terminal, so you might even get a longer runway. But whatever the case, you still have a window where you can file as married filing jointly and utilize those tax brackets and deductions. And so why not pay some taxes and accelerate some income to do Roth conversions to get those pre-tax dollars into a Roth account? Okay. It is not lost on me that if you find out something is going to happen to your spouse or your spouse passed away suddenly, probably the last thing on your mind is to freaking do Roth conversions. That's not lost on me at all. So I understand that this can appear like tone deaf. You're like, I got bigger things to worry about than Roth conversions, but my job here is to talk financial planning. So it might, I emphasize, might make sense to do Roth conversions if you're in that situation. So what are the benefits of doing Roth conversions as far as the widowhood penalty is concerned? There's sort of 3 different benefits. The first is that money that you pay as a married filing jointly couple and get into Roth dollars, if you take it out as tax-free income, it obviously won't drive up your income to higher tax brackets when you're filing single. So that's a benefit. The second benefit is that in terms of IRMA, Roth distributions don't count towards modified adjusted gross income to determine those IRMA surcharges. So, if you take a Roth distribution 2 years later, it's not going to have an effect on your IRMA surcharges for Medicare. And then the third benefit is that once you pay taxes on funds and convert them into Roth, the IRS is like, okay, these dollars have had their hand stamped. Our dealing with them is done. So there is no required minimum distribution, which again could help with the tax bomb. So obviously having more money in Roth accounts is beneficial for a multitude of reasons, not just the widow's penalty, but if you are in a position where you can utilize married filing jointly brackets and deductions, you might think about doing Roth conversions. I will say, give a disclaimer that Roth conversions are very, very case by case. So it's not just, I'm not advocating for them across the board. They depend on your current tax bracket, future tax bracket, your assumptions on changes in the tax code, tax diversification that you might have, how much Roth and how much taxable account you have. There's a ton of different stuff that goes into it. So it is something to look at. I will also give a scenario where it could make sense sort of on the opposite end of the widowhood spectrum. And that would be if you have a younger widow who has a dependent child, and so can have 2 years filing as a qualified surviving spouse. And let's say the earner of the household was the deceased spouse, and that surviving spouse is the beneficiary to a substantial life insurance policy, which is tax-free. And so that surviving spouse now finds themselves, they're going to take a couple of years to, get everything together. So they don't plan on working and living off the life insurance proceeds, or maybe they did work and their spouse worked as well. So now they're down to one income versus two incomes. So their taxable income could come down substantially in those years when they're filing as qualified surviving spouse. And that might make sense for them to do Roth conversions. Then they can do it on their own pre-tax accounts if they are the beneficiary of their deceased spouse's IRA. That's a whole other episode I'll do on whether to roll it into your own IRA or keep it in the deceased spouse names. The IRA has to do with RMDs and liquidity, and also you would need to roll it into your own IRA in order to do Roth conversions on your deceased spouse's pre-tax dollars. But you can see these are all just things to consider, right? As far as tax planning, there's a lot of different transitions that come with widowhood in all aspects of life, and it's, the taxes are not unique to that. You're not, the taxes are included in that as well. So as far as Social Security is concerned, if we look at strategies for Social Security, the sort of straightforward strategy, if you're trying to really minimize the widowhood penalty with a reduction in Social Security with the passing of a spouse, you might want to delay the higher benefit if each has their own benefit, or if there's just one benefit, to delay the benefits as long as possible, because those delayed retirement credits that you accrue by delaying past full retirement age, they do have a survivor aspect to them. So they will be included in the survivor benefit for the surviving spouse. So if you're trying to minimize the reduction in Social Security, should either spouse pass away, it might make sense to delay the higher benefit as long as possible. Okay. So that's a common strategy. And I would go listen to my last episode if you haven't done so, and you're not really aware of how survivor benefits and your own benefits can interact. There's a lot more information there. So those are the two main strategies. You could also do qualified charitable distributions. That's if you have, like one of those we talked about earlier, having a pre-tax problem where you have all this tax deferred growth and you're forced to take required minimum distributions, and you're charitably inclined and you don't necessarily need the money, then you might be able to give those funds to a qualified charity, have it satisfy your RMD, and that income never hits your tax return, so to speak. So it's not taxable income to you, and it won't affect your IRMA surcharges 2 years later. So that could be an option. But again, that's case by case. And it goes without saying that if you need the money, you need the money, right? You're giving it to charity in that situation. But that could be a strategy if you're fortunate enough to be able to give to charity and reduce your taxes. So that is it for me. That's what I got for you today. I just appreciate you all listening, and I look forward to continuing to make these. And please reach out if you have any questions, comments, or anything. Just reach out at any point. My email is jeff@hilltopplanning. That's jeff@hilltopplanning.com. So until next time, I hope you all have a great day, and I am signing off.